Okay, guys, welcome back. So we're looking at this transaction, not two. It says sales include 4 billion for the goods sold in March for a cash consideration to Kampala Bank, and the cost of goods sold is 3 million. Guys, please mute. Kindly mute. So, I'd say that the 4M is not actual sale. You're supposed to record it as a deferred income. Reason being, the terms of the contract under sale do not allow you to recognize a sale yet until the 2 months elapse. Okay, that is if there's no return. All right. So because of that, like I already said, you record deferred income. Then the cost of the goods, you're saying still our inventory can't be reduced by 3M because you're not actually sold it yet. You just like you've taken it to another warehouse. Okay, so because of that, our inventory still remains the same. We're supposed to restore our inventory, our closing inventory by the 3M. Hence, we saw us debiting the inventory with 3M and crediting cost of sales with 3M. Then this facilitation fee, we're saying that since it is possible you're going to incur it, you make a provision for it. Okay, the provision is you're just trying to safeguard just in case it happens. It shouldn't be abrupt. Okay, so therefore you create a provision. Hence, you create a liability of 125 and realize an expense of 125. Okay, that's what we are seeing in our worksheet here. Okay, so I had stopped on the facilitation, which is the last item. Okay, it's not the last, but cost of sales is the last one. So so we're on the 3M. So we're saying go and debit your closing inventory with 3M. That's why we increase this value with 3M, 3 billion. Then credit cost of sales. Okay, so you come here under cost of sales and you say, how can I call it? How do I call it? Goods sold. So you can say goods. Okay, I put the figure right here. Okay, goods sold yet, goods sold and yet to return it. The 3M. It's a credit, so it's a minus under cost of sales. Okay. So we are done with note 2. If there are any questions, feel free to share them in the chat. Okay, so let me go to the next note, which is Teddy, kindly mute. Note 3 is non-current assets. Teddy, kindly mute. So the non-current asset, once you look at it, you know it's already working. Okay, so you go and do the working. So here basically you draw a schedule. Okay, I can call it working 4. Working 4, and I'm saying this is IAS1 PPE schedule. So the PPE schedule, what you do is you go to your trial balance and see all liabilities. Okay, why have we categorized 3M as cost of sales? It has what? It has a formula. Okay, just a moment. So allow me share the trial balance. So I'll get back to that Clever. Anyway, cost of sales has a formula, yes, but we are saying that the cost of the goods, it's not cost of sales, but the cost of the goods. Okay, the cost of the goods sold were 3M. They didn't say that the cost of sales. Like you want to have it as opening inventory plus purchase minus closing inventory. No, we're saying the goods that we have sold, the cost of them, the value of the goods sold is 3 million. Okay, so that's why we are saying it's the cost of goods. So how do we treat that, or how do we eliminate the cost? We're saying go back and restore the inventory and remove it under cost of sales. Okay, you know, the cost of sales actually records cost of inventory sold. Okay, I hope you know that. So back to the working. So I was saying, so I was saying you come and you go to trial balance and pull out all the assets. So you have land. I hope you can see the figure. Where is it? Here, land and building. Okay, so you have land. Then you have a building as the other asset. Then you have plant and machinery. This one is combined. Okay, then the total column is really optional, but let's have it since I'm using Excel. But you don't have to really have it because I don't think you have time to add all those costs. Okay, what you need are the final figures at the end below land. Okay, so then you have details. Okay. The first thing you do is pull all the cost information which is given in the trial balance. Okay, so land is that's the balance carried down or brought down. Okay, I'll share the worksheet just shortly. Okay. So balance carried down all the costs actually. It's cost, let's say cost at 1st March 2017. So 2018, right? Okay, so 2019. So it's at 1st April 2018. Okay, the beginning of the year. Okay, so the cost was given for land is 600,000. Okay. Then building is still 600,000. You're looking at cost. Then you have a plant. The cost is at 2.4. Okay. 2.4. Then we have accumulated depreciation. Allow me also take those figures. I want to come back to the trial balance. Okay, accumulated depreciation for plant and machinery. It is it is 1020. Okay, then building. Depreciation is at 180,000. Hope you can all see the figure. And it's only for building because you know the land and depreciate. Okay. Yeah, so we're good with the trial balance. Okay. We're good with the trial balance. So let me take you back to additional information and see what they were saying. Additional information. Okay, yeah. So this is what they're saying. They're saying this is non-current assets that you're seeing at 600 and 600. Even though in the trial balance, which is the ideally the figure at the beginning of the year, say 600, we are saying that the cost was actually on 1st April 2003. 2003, okay, very many years back. Then we are saying that on 1st April 2018, this is the beginning of our current year. These values, all the land and building, were revalued and have a revaluation of 625 and 700 officially. Okay. So what we're going to do is we're going to first deal with this information revaluation at the beginning of the year and see how it looks like. Okay. Let me take it to my working. Okay. Yeah, is my schedule. I just brought the information that I had in the trial balance. Okay. And this was accumulated depreciation at the beginning of the year. Okay. So this is what you have. Now we're asking ourselves, what's the carrying amount at this very date? Okay. So carrying amount, since revaluation occurred at the beginning of the year. So we want to determine the carrying amount at the beginning of the year, then compare it with the revalued amount at the beginning of the year. Okay, that is IAS what? IAS 16 revaluation model. Okay. And then we see if there's a gain or a loss, then accordingly post it. Okay. So we're saying carrying amount at 1st April. This is the beginning of the year, remember. Our year ends on 31st March 2019. So our carrying amount here, I'm going to use negatives for depreciation or accumulated depreciation. So that I just add. So my carrying amount will be costs minus accumulated depreciation. This is at the beginning of the year. Okay. Then what's the carrying amount? Okay. The carrying amount, also the revalued amount. The revalued amounts that they gave us. They say that for the land, it is 625,000. Okay. And then for the building, it is 700,000. Okay. They didn't say anything on plant and machinery, meaning that they didn't revalue plant and machinery. So we come here and see, okay, revaluation. You know, to compare revaluation at the beginning, sorry, at that date of revaluation and the carrying amount at the same date. Okay, so revalued amounts at 1st April 2018. Okay, so do we have a gain? Okay, whenever the carrying amount is less than the revalued amount, there's a gain because it has increased from where it was to the new figure. So this is a gain. You come and say gain on revaluation. So it's a balancing figure. You can say whatever it is, okay? But it's the difference between the two. So hence this minus that. This is a gain, okay? Even building is a gain. Okay, of course, we didn't revalue land, so there's nothing. So therefore, land we expect it to have this carrying amount, the same carrying amount at the end. Okay. So how do we treat these gains? Remember, I told you every transaction or anything that you bring in new must always have a debit and a credit balance. So we have a gain on revaluation. So by it being here, remember the entries for gain on revaluation. Gain on revaluation. This is IAS 16, revaluation model. We say that you debit the asset itself because it has gained value. Okay. Which I've done by bringing it here so that the asset increases from 600 to 625. You have added this 25. So that's the debit you're referring to. Debit 25,000. This goes for the land. Then for the building, of course, it is 28. Those are debits. Then what do we credit? We credit the OCI. Okay. We credit the OCI straight on a condition that there wasn't revaluation before that gave us a loss on revaluation. Because if there was a loss on revaluation before, it means that we went to the P&L and put the figures there. So before you bring any figure under OCI, you must first restore the profit or loss to normal. Okay, so I don't want to go into that really. That's IAS 16 revaluation model. I think we already discussed it. Yeah. I discussed with you. So kindly refer to the videos in case you forgot it. I will deal with the gain on revaluation. Otherwise, it comes here. Okay. Okay, so this is a debit and credit. So we are saying this figure already put here, so we debited officially. This was done. Okay. Part of the credit we are saying you go to the OCI. So OCI, we all know it's under the P&L. Okay. P&L, then you come here and say other comprehensive incomes. Okay. Then you say gain revaluation. Okay. Allow me bring a total figure here rather than the split. So we had that 25,000, then we had the 80,000. Okay. So by doing this, yeah, crediting. Okay, we know that incomes are credited. So that is it under these journals of gain and revaluation. So let's look at the continuation because I'm not belong here. So officially we have revalued, okay, as the additional information is concerned. So let's go on because you know that with non-current assets we have to depreciate them and do all that kind of stuff. So if I may take it to additional information and we continue. Okay, so I just dealt with the revaluation bit. Now they're saying the buildings had an estimated life of 50 years when they were acquired. Okay, remember they were acquired on 1st April 2003. So on that very date, they had a 50-year useful life. And they're saying, and this has not changed as a result of revaluation. What does that mean? It means that the useful life that the asset has now has not changed. Okay, the value may have changed to 700 for the building, but the useful life did not increase in any way or reduce in any way. Okay, so what does that mean? It means that the remaining useful life of the building, okay, is not 50 by 2018, but it's the balance that remained after consuming it since 2003. Okay, so what we do is you count the years so far that the asset has consumed from 1st April 2003 till 1st April 2008. How many years are those that have been consumed along the way? And that now what is left is the remaining useful life. So let's do the math. Take it to my working. Okay, so I'm saying, looking at the depreciation. Okay. Looking at the remaining useful life. Remaining useful life of the revalued building. Okay, so we're saying from 1st April 2003 to 1st April 2018, how many years have been spent, okay, or have been consumed? So ideally, it's supposed to be 15 if you count, okay? If you don't know how to count this, I can guide you through. Okay. So we're saying that from 1st April of 2003 to 1st April of 2013, those are 10 years. Okay, still, if you can't get that, you can say from 1st April 2003 to 1st April 2004, that's 1 year. 1st April 2005, those are 2 years. Okay, 1st April 2006, those are 3 years. Like that, like that. I don't really want to count that for now. Okay, because of time, but you count like that till the closing date, which is 1st April 2008. The number of years that you have counted there should be 15 years. Okay, then, so this is what you have consumed so far. So meaning that what is remaining, remember it had 50 years at the beginning, okay? At 1st April 2003, its full life was 50 years. Okay. But what is remaining now at 1st April 2008, 18, sorry, it can only be the balance, which is 50 minus 15. So we have 35 years. So this is the remaining useful life of the building. So when you come to depreciate it, therefore, when you come to depreciate, you shall say depreciation for the year. Okay. Maybe if I take it back still to the additional information first, so that you don't say, what's this guy saying? Okay, they're saying that, okay, the buildings had an estimated useful life of 50 years when they were acquired. Okay, they were acquired on 1st April 2003. And this has not changed as a result of revaluation. Okay, like I said, that means that they didn't revalue the useful life. Okay, if the remaining useful life is 35, it wasn't increased to 50. Okay, so it's 35. That's what we are trying to compute there. Then they said the depreciation is on a straight line basis. Now, straight line basis says that you use cost over useful life. So unfortunately, you had a revaluation. So when you have a revaluation, the cost, you have a new cost now. The new cost is 700, but the useful life still also becomes new, which is now 35, the remaining one. So therefore, the depreciation for the building, let me take you to the working. Okay, building. Just put it the working. We're saying it is 700, which is the cost now over the remaining useful life, which is 25. Okay, so building should have 700 divided by 35. It is 20,000. Okay, and because depreciation, we know that it reduces your what? Your assets, hence minus. Okay, that is one instance. Then look at the remaining asset. Plant and machinery are depreciated at 30% on the carrying amount. If they don't say carrying amount, they will say on reducing balance, the same thing. So 30% is charged on the carrying amount. So when you come to your working, this plant here, okay, let me just put it here. You're saying what's the carrying amount? It is 1,380,000. On the carrying amount, that's why we charge the rate as far as reducing balance is concerned. So I say 30% of the carrying amount. That is the depreciation for plant and machinery. And you're done with the note. So we know that with depreciation, the entries are, okay, that you debit depreciation, credit estimated depreciation. Ensure that you said the asset. So this credit here, I bring these figures here under the asset register, and yet they are negatives. We are crediting. Okay. So our debits must end up in the profit or loss as depreciation. Okay, but the note was saying, or the note was clear on that. It said that okay, there's no note here. So whenever there's no note to tell you where to throw the depreciation, okay, usually they tell us cost of sales or anything else. Okay, whenever they don't say clearly that you take depreciation, cost of sales in the P&L, you take it under admin. Okay, so you're saying you come under admin, under working, yeah. Or this working 3 under admin, put depreciation. So you come here and say depreciation. Allow me combine. Okay, so we had a 20,000. Then we also had a 414. So meaning officially our depreciation here is 20,000. So, okay, so because they're expenses, of course, and you're debiting, so they are positive here. Okay, we're done with depreciation. If you have any questions, please share with me in the chat. Otherwise, we're going to the next note. So the next note, what does it say? The next note says that note 4, the balance relating to income tax, okay, the trial balance relates to the under or over provision from prior year. So whenever you see something like that, that will take us to our working. Why is it under administration? Depreciation of assets. Okay, it's under admin. Reason being, it can't be under it can't be under cost of sales, because we know that under cost of sales we are referring to opening inventory, purchases, and closing stock. We know that by the standards, at least by from the previous. Okay, since we have been doing cost of sales, depreciation has never been under cost of sales. Okay. Under distribution, it would fall under distribution, but we know that distribution is for what? Is mainly for selling. Okay, sales. If you're making sales, that's when we go under depreciation, under distribution. Okay, so if maybe it was maybe depreciation on a vehicle that we use in distribution, then you may want to take it under distribution cost. Okay, so you're only left with admin as the only option. So patience, I hope I've made it clear. Depreciation is always under admin, and the reason is because admin caters for all other expenses, okay, that we normally incur. Other expenses are kind of classified. So for cost of sales, we know for sure, cost of sales, we always have opening stock, closing purchase, and what? And closing stock. So it's only taken to cost of sales if they have told you clearly. If the question says you allocate depreciation to cost of sales, then you have no choice. But why they tell you that where they're silent, they don't say anything, then it must go under admin. Patience, I hope we're together. Then the one was asking about 35. 35, we said that though we are not compute 5 years. Are you asking the question or commenting? According to the question, depreciation for PPE is on reducing balance. Plant and machinery, yes. Though we are to compute, the 35 years are on the building, not plant and machinery. Clever, I hope. I don't know whether you're trying to clarify or ask a question. I'm not getting you. Okay. So maybe you can clarify. Otherwise, the useful life is on the building. Plant and machinery is alone also. It's different. So you depreciate building alone and plant and machinery alone. The methods are different. So patience and clever, I hope I've answered your questions. So let's continue. I was saying continue with the note.
Yeah.
Okay. So we are going to income tax. Okay. So maybe if I go to my working, let's see the balance in trial balance, what they're saying. So when you look through income taxes here, the last note, it is 56,000 and it's on the credit. Okay. So when we go to our workings, this is working 5. Okay. I'm saying it is IAS1 income tax. Okay. We're saying you have an over provision. And we know the reasons. Okay. At least the lecturer was clear on this. Over provision, reason being that the trial balance figure is on the credit. If the figure is on the credit, that's over provision. If the figure is on the debit, that's under provision. Okay, and this means I intend to cover the income tax. So how do we deal with this? Okay, how do we deal with this income tax? Remember, it was 56,000 on the credit side. How do you think? Okay, Rona, thanks. Javi, I hope you answered. Okay, so we have this credit. Now, with me, or an advice I can give you, don't really mind about how we call this, whether it's an over or an under provision. Although if you know it and you're sure of it, feel free to write it in an exam. But if you're not sure this is an over or an under, don't write it. Okay. Just say it's the trial balance on the credit side. So how do we deal with this? Usually, okay, maybe let me share the whole thing, read the entire note, so I don't do them in bits. So it says that the balance relating to income tax in the trial balance leads to an under or over provision from the prior year. Then it says that the tax estimate for the year ended 31st March 2019, this current year, they're saying it is 9 million. That's the estimate for income tax. Okay. Then you have a deferred. So for the deferred, we shall do it like last. Let's first do income tax alone. So we have a new provision also. It's a provision. Okay, at 9. So what are the entries that we do for this? Let me begin with the under or over. Now, under, whenever they say it's on the credit, just know you're supposed to remove it. So in removing it, you debit. Okay. And you're debiting provision. Provision. Or okay, provision for tax, or you can say a tax payable. You know that a provision is a liability. So that's one. Then the credit goes to the tax expense itself, income tax or tax for the year. Okay. So this 56 is supposed to be treated as simple as that. Okay. If you had an under, okay, let me just take to over for now. Okay, otherwise for the under is the opposite. That because you have a debit, you want to credit first. Okay, but at the credit, so you're debiting. Debit provision, and the other entry automatically goes to the account that's affected, or the expense that you're talking about, which is the income tax. Okay, income tax is 1,000 in the trial balance, not 56. Really, that's what did I see? Let me check again. Income tax. Okay, it's 1,000. Then deferred is 56. Thanks, Ron, for the correction. So income tax is 1,000. So what are the entries? Then we look at the provision. The provision has its own entries as well. That once you create the provision, it's supposed to realize the liability, hence credit provision, and debit the expense itself, what you're trying to provide for. So it's supposed to therefore debit income tax. And credit the provision. Or you can call it the tax payable. Okay. Since we're saying it's a liability. Okay, how much? It's 9,000. So those are the entries. So take note that what you see here, these are changes. These are same accounts affected. One is increasing, one is reducing accordingly. Okay. So if I told you to tell us the total income tax, you would tell us that it is quoted by 1,000, yes, but was debited by 9,000. So the net income tax must be 9 minus 1, hence 8,000. Talk of the provision. The provision is saying that in the beginning it had 1,000 in the trial balance, but we made an entry of a debit, hence removing it from 1,000, but we also gave it another 9,000. Okay, I'll show you the changes of this. So let me just continue. Now let's go to deferred. Okay, deferred tax. Deferred tax was just a provision. They say that you had a balance brought down. The trial balance is 56,000. Okay. Then they say they have a closing now, a closing one, closing deferred tax. Of how much? The note says what? Deferred says that the required deferred tax provision on 31st March, the closing date is 50. So meaning that this deferred is supposed to be revised to 50. Okay, and they're saying that the movement are to be taken to statement of profit or loss. Okay, so the closing therefore is 50,000. So for the deferred, you just look at the difference or the change. That in the trial balance, it was at 56, but has been reduced to 50. Now the difference is what you cater for, is where the entries fall. So the difference is 6,000 and it's a decrease. So you say decrease, but so in provision or deferred tax. Okay, the decrease is 6,000, you can all see it. So what are the entries for the decrease? Whenever any liability reduces or an expense, actually liability, we recognize an income. So we're supposed to credit, okay, debit first. Supposed to debit deferred tax or provision for deferred tax. Provision to the liability account. And then credit. Okay. In this case, deferred tax does not appear in the income statement, but it goes under income tax, the expense. Okay, the difference is 6,000. So for deferred, we're only interested in the change. Okay, and that change is what we deal with. The change is that we debit the deferred with 6,000 and credit income tax. I respond to some chats. What about if it's an under? If it's an under, like I already said, you just do the reverse. Only this changes, only this part is what changes. If it's an under. Okay. You have an under provision. Under provision, we are saying the trial balance would be on the debit. You will have a debit balance. Okay. So assuming the figure is different, 2,000. The entries would be that you want to remove it. Okay, so since as a debit, the first thing is credit. So the credit you do is you credit the provision. Credit provision. Okay. Or you can call it tax liability. Tax payable liability. Tax payable. And then you debit the expense itself, which is the income tax. So this out will be different if it was an under. But the other things would remain the same. The estimate, this one, provision for tax, even call it estimate so that you don't confuse. Estimate for the year. Of tax at the end of the year. Year end. Okay, this one remains the same. Deferred remains the same. Just look at the change. Okay, so these are the entries.